Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Aqua Metals stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Aqua Metals has a superior process for recycling lead batteries that drastically reduces emissions. Since the process is safer and cleaner, it reduces the amount of permits a company needs to recycle lead batteries. The company is headquartered in McCarran, Nevada, and was founded in 2014. It went public in 2015 and currently trades on the Nasdaq, Deutsche Börse, and London Stock Exchange. It recycles lead-acid batteries and recovers lead from those batteries, since lead is a finite resource that's used in a lot of things today. Lead batteries store renewable energy generated by cleaner sources like wind and solar. Lead batteries are the cheapest and most common in regular cars and can also be found in some electric vehicles. The company filed provisional patents for its lithium-ion battery recycling process and its process for manufacturing batteries with lead oxide. It is currently in phase 2 of licensing its technology to recycling facilities around the world. Let's get started with the model. This is a micro-cap company, 193 million market cap. They're trading at $2.83 a share, and they have 68 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have negative free cash flow each year because they're not bringing in much revenue, because they're still trying to get through the approval process so it can start licensing its technology. Net income is the profit and loss on the income statement. It's revenue minus expenses. That's also negative each year. Revenue is the sales for the company, and that's pretty low from year to year. They did peak at $5 million in 2019. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. And they have negative gross profit each year because they're not bringing in much revenue at this point. Below that is operating expenses, such as research and development. Then below that is operating income. They paid $1.4 million of interest on their debt, which is the lowest amount of interest they paid in the past 4 years. Then you have other income and expenses. This is usually impairments or write-offs. And the bottom line of the income statement is their net income, which of course is negative every year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. And then you have capital expenditures, which are investments in property, plant, and equipment. They spent $13 million in CapEx in 2019, $2.4 million in the trailing 12 months. And of course they have negative free cash flow each year, so they need money from somewhere to fund their business. They're mainly funding their business with capital stock. That's why they went public. They raised $29 million in 2018, another $29 million in 2019, and $3.7 million in 2020. Every time the company issues capital stock, this increases the shares outstanding, making your shares less valuable. Let's look at the capital structure. They have $37 million of equity, $1 million of debt. They're 98% equity, 2% debt. Their net debt is negative $11 million, and their WACC is 11%, and that's a discount rate we're going to apply to the future cash flows. We estimated 7 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 7, that's $749 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $401 million. We divide that by 68 million shares. And we get a calculated stock price of $5.90. They're trading at $2.83, so they're trading at a 52% discount. It's a strong buy according to the model. My model assumes they'll be able to license out their technology in the coming years. Of course, if they have difficulty getting approval, or if other recycling facilities are not interested in their products, then they of course may go out of business. Simply Wall Street is a lot higher than me, over $18. They're saying the stock is extremely undervalued. 2 analysts priced this stock. The average price target was $7.50. The low was $7, the high was $8. This is the stock price in the past 5 years. So it broke through $20 at one point. There was a lot of excitement around this stock. But when investors don't see instant results, they sell off and they push the price much lower. It did pop up at one point, but it's come back down a little bit. Their beta is 1.64, so the stock moves about 1.5 times the market. The stock has gone up 300% in the past 52 weeks, while the S&P 500 went up 46%. The 52-week low was 64 cents, the high was $8. And the stock is trading below its 50-day and 200-day moving average. About 1 to 3 million shares are traded each day on this stock. Of the 68 million shares outstanding, 65 million are on float, 19% are held by institutions, and about 7% of the shares on float are shorted. In the past year, this stock has done really well, up 280%. Its industry up 51%, the market up 55%. But in the past 3 years and 5 years, this stock is negative, while its industry and the market are up a lot. Analysts are forecasting their earnings to grow 68%, its industry to grow 21%, and the market 16%. Analysts are forecasting their revenue to grow 55%, its industry 7%, and the market 9%. In the past 5 years, their annual earnings decreased 17%, its industry increased 9.5%, and the market increased 12%. In the past year, their earnings increased 32%, its industry decreased 8%, and the market increased 14%. If you invested $10,000 into this company when it IPO'd, you'd be at $5,300 today. That's a 47% loss. The biggest shareholders, Canal Capital at 4%, Canaan Wealth at 3.5%, Vanguard at 3.5%, the CEO at 2.4%, and IEQ Capital. Let's look at their financial ratios. The average PE in the market is 33, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so we can't look at the PE. Their price sales ratio is really high because they don't have much sales. Price to book is stock price over book value per share. They're at 5.2, which is between the median and average. They have negative EBIT, so they have negative return on invested capital, negative interest coverage ratio, negative ROE. Their current ratio is 3.3, so they can easily cover their current liabilities. And most of their current assets are cash of $11.7 million. So the company does seem to be undercapitalized. They had negative $11 million of free cash flow, $9 million of working capital, so they're short $2 million. So they may need more debt or equity over the next 12 months to run their business. The best way to look at ratios is to compare them to companies in the same industry. The only other two companies I did in the same industry are Waste Connections and Waste Management. Aqua Metals has negative earnings, so we can't look at the PE. Aqua Metals is doing much worse in price of sales. They are doing better in price to book and current ratio. They have the worst ROE. They are lowest in debt of all the three companies because it's really hard for companies to get debt financing when they're pre-revenue. And of course, they're the smallest company by far of the three. So to summarize, I have them trading at a 52% discount. This company is doing something totally different than anyone else. They're trying to recycle lead batteries and pull as much lead out so they can be reused. Lead is one of the most common and important commodities in the world. There's lead in so many things. If this company is successful with their technology and they're able to license it out to others, then the stock could go way higher. I rank their free cash flows 1 out of 10, their revenue 1 out of 10, and their ratios 2 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.